It is Friday the 23rd of August. I'm your host Ryan Kia, and this is the Quantum Cast. It seems that nothing has actually been happening since last night's 8 AM podcast release of the Premier Oil chart pack. But anyways, futures seem to be looking relatively strong, up about 0.5%. Then obviously regards the FTSE 100. But anyways, let's get into today's focus stocks, and they include Stobart, Quadrise Fuels, Entertainment One, and finally Computacenter. Okay, so beginning with Stobart Logistics PLC, this company has just released a piece of news talking about a directorate change, but also a potential suspension that is going to occur today. In fact, not a potential one, it is an imminent suspension. We can see that the CEO, Alex Laffey, has mentioned he's going to stand down ahead of basically an accounting scandal. They haven't talked of him having any link, but they do mention later on that they are pending the clarification on what their adjusted EBIT, so earnings before interest and tax, is. And they mention it's very unclear, to the point where it's likely to be significantly lower than anticipated at the time of the half-year trading update on the 9th of July 2019. So what they're going to do is review the group's dividend policy, meaning they could potentially scrap it. Not a positive thing for the shares. And they've suspended the shares to also go through things with their auditors and see what went wrong. The shares are off highs of about 250 pence per share post-IPO. The IPO was around 120 odd pence. The current price is 113 pence per share, and that gives them a market cap of £419 million on a PE ratio that I can't seem to find. And in fact, the reason why we shouldn't bother about the PE ratio is that this company could potentially have materially lower earnings than what they've actually reported. And goodness knows, this could be another scandal like Patisserie Valerie, to the point where the company actually doesn't make money and has a hole that exceeds its current capital. But we'll have to see. I express my condolences for all shareholders, but also wish you the best in getting through this tough time. Moving on to Quadrise Fuels. This is quite an ugly RNS, to say the least. They've mentioned that, yes, they are raising money. They've secured funding of 2 million and a potential further funding of 2.3 million pounds, meaning that the company has enough capital to survive. We mentioned actually in a couple episodes before, when we last mentioned Quadrise Fuels, that their current cash burn rate had suggested that they'd have to raise money, otherwise by around October they would run out of cash. And surprisingly enough, my suspicions were right, which is nice to see. Obviously for shareholders it is a little bit upsetting, but what also should be taken into account for anybody either invested or looking to invest in this company is that it was done via convertible securities. That is always the last option when you're looking to raise money. And it seems that the company has done this with ease. £2 million is going to get converted, basically diluting current shareholders to the brim, unless the shares are somehow demanded to the point where that £2 million really doesn't matter. But we shall have to see, really. I think it is worrying that there is one 2 million tranche and a further 2.3 million pound tranche. So the company is basically saying, yes, we're going to dilute you now, and we're also going to dilute you in a bit after that. There isn't really much upside in that case on the shares. But we mustn't get too worried about the size of this placing, because the market cap is £40 million, and even including their second tranche, this is about 10% of the issued share capital being added on top of the existing capital. The current shares have actually, as this car just goes by and revs its engine for the sake of it, their shares have made highs of 7.5 odd pence per share this year and lows of 1.87 pence per share. So it'll be interesting to see how the reaction is, but the only indicator we have of where the price is going is down, because the plating is mentioned at around 3.6 pence per share, sorry, 3.96 pence per share, which is around a 10% discount. And there are some warrants being offered, so there is an incentive for people to hold if the price were to, say, break above 7.48 pence per share, which is almost double the current price. Before we finish with those guys, I must express that convertible loan notes or convertible securities are horrible for a company's share price. In fact, the way it works is that the conversion price of a certain amount of shares is the average of 5 daily volume weighted average prices of the ordinary shares during a specific period before the conversion date, and they round it down to a tenth of a penny. Or say if you have if you exceed 140% of the average daily volume weighted average price for the 20 days immediately prior to the execution date of a certain set agreement. So whenever they execute a maximum of £800,000 of convertible securities, they will be sold straight into the open market. So it's almost guaranteed dilution. Shares of companies that do these kind of things almost always crash, and I'd expect to see these guys have a really negative impact after this, but we'll have to see. Moving on to Entertainment One. This company is formerly known as the owners of Peppa Pig, which I assume many of you are aware of. Probably the wrong audience, but they have in fact been acquired, or I believe there's been an offer that has been accepted by management from Hasbro, and I believe Hasbro have paid a premium of 31% to Entertainment One's 30-day volume weighted average price as of the 22nd of August, and that values Entertainment One at approximately £3.3 billion. It's really an impressive situation for shareholders, and in fact a lot of people on Twitter have been saying that ETO has been a prime target. So congratulations to all of you who actually had positions in these companies and put your money where your mouth is, which is absolutely wonderful to see. Congratulations once again. And it seems like, as you normally have with these kind of takeovers, executives from one side have gone to the other. From Entertainment One, a lot of top executives have agreed to join the Hasbro team. So Hasbro is trying to just build their power, but also get key talent from elsewhere, which is an impressive bit of decision making shown by the company. I believe this is probably going to go through. Hasbro have actually mentioned that they're maintaining their quarterly dividend, and the only thing that they will change is the fact that they're suspending their current share repurchase program, as they're trying to get a certain leverage ratio to make sure that they don't have any issues with lenders, etc. But that's really all we can take from this. Congratulations to shareholders. I do wonder, in fact, what the highs were for the year. In fact, we can get them up right now. 485.4 pence per share and lows of 333. So if individuals were in at the lows around December, when the markets were battered, then you'd make quite a bit. In fact, almost would have doubled your money. And quite a lot of long-term investors and value investors have been looking for entries onto this stock. In fact, 5 years ago, not even 5 years ago, 3 years ago, on the 19th of February 2016, the shares were at £1.33. Wow, a lot of value. But they just crashed from highs of 371 in July 2015, so yeah. And finally, Computacenter. This company proclaims itself to be a leading independent technology partner trusted by large corporate and public sector organizations, and in fact today they have announced their interim results for the 6 months ended the 30th of June 2019. In terms of a revenue front, we've seen an increase of 3.6% in comparison to the first half of 2018. That is of servicing revenue, but if we're talking about total revenue, they've had a huge rise by 20.8%, and that doesn't actually have much of an impact on their profit before tax, which is worrying. Their profit before tax is down about £1.2 million, yet their revenue's up about 420 almost million pounds. That is a little bit worrying. I assume their margins have probably been hit by that kind of thing. Their cash position, cash is up, net debt is up, though that's the problem. So a lot of the time, if you're borrowing more money, yes, you do have a bit of liquidity, but you have to pay more back. So in fact, your debt increases by a higher rate than actually your cash does. What is impressive though is that this company had released a profit upgrade RNS on the 31st of July 2019. They'd released a trading update and they'd mentioned that actually they were upgrading such expectations, and they also mentioned now that their outlook remains in line with those expectations. And it seems that the first half of 2018 did show a difficult period to beat, yet they did in the second half. However, the company's profit growth has been one of the best in history. I believe that's what they're mentioning. So I can only assume that a couple of acquisitions are the main causal factors as to why the company hasn't made as much profits as you'd expect it to do with such revenue growth. But nevertheless, if we're talking about adjusted profit before tax, they've increased it by about £1.4 million. But you've got to look at acquired tangibles and adjust something for the amortization, which is a topic we'll talk about another time because it will take too long to explain. But that was about £2 million. So you can see that brings their statutory before tax profit down to £50.8 million. Computacenter has actually recently acquired a company called Fusion Storm, and these costs that they've been taking in the short run will likely have a strong impact in the company's future accounts. Looking at the company's shares though, we can see that they have year highs of around 1,550 pence per share, aka £15.50 per share, 52-week lows of about 936 pence per share, and the market cap at the current moment is 1.6 billion with a price to earnings ratio of around 20, I believe. If you assume a constant currency basis, Google is overstating it a little bit. I believe that it's probably towards 15-16 territory. And these kind of companies, once again, they can make a lot more profit if they get big contracts, but we'll have to see how their second half earnings look. But this company is actually trading near their year highs. They're at £14 per share. They were down 40 pence yesterday, so they're about 14.40 there. Their highs were achieved on the 31st of July when they had that profit upgrade RNS, and they were down shortly after that. And the chart is very interesting. We'll have a look at that later, in fact, in the chart pack. I shall note that down right here, CCC, the ticker symbol of the company right there. And they've been very volatile, in fact. I mean, lows, as I mentioned, 936, highs of 1550-ish, and from 1550 they went down to just under £10, in fact £9.86 within about a month after that trading update. That was almost a 40% drop, which is quite worrying for people who are looking to get an investment into a stock with lower volatility levels. But you have to take a risk, don't you, if you want to get the reward, because this company over 5 years has done alright. Lows of around, I believe, 600 odd pence per share, and the highs, as mentioned, really 1550 odd. And it seems though over the past 10 years the shares have done really well. We don't usually look back this far, but 2008, they had prices at around £1 per share, obviously because of the recession, but they have recovered ever since. The only recent major crash that they had was in 2018. In fact, that was a little bit worrying to look at. In fact, I must correct, I made a mistake. After the 31st of July, the shares had dropped about 10%. If we're talking 2018 December, the shares had fallen about 40% after the same kind of period. And the shares had spiked around the similar level of highs at about £15.50 per share. So that wraps up today's episode of the Quantium Cast. I've been your host Ryan Kia, but before I head off, if you want insight into the technical side, then keep your eyes peeled for any additional content posted later on in the day on our site, or you could check our podcast to see if it's been released on there. This includes the analysis of charts of some of the companies discussed in this podcast. But first, head on over to our site, quantiumresearch.co.uk, and download the relevant chart pack for that episode. And for today's, that will be 17+. It should come out later today, around 6 p.m. to 8 p.m. But as I look to have another sip of my beloved super malt, I've been your host, Ryan Kia. Until next time.